Good day and a warm welcome to Market Views, a show that breaks down what's happening on Zimbabwe's capital markets, the numbers, the trends, and what they mean for you. I'm your host, Kudakwash Taimo, and I'm excited to kick in our weekly market review as we unpack the movements and the trends that has been taking place for the week ending 26 September. Let's dive straight into it, shall we? All indices on the ZSE closed in the green, except for the ZSE Top 10 Index, while the VFX recorded further gains, right, with no counter closing in the red. The ZSE All-Share Index, it actually surged by 100 basis points. This came after an 80 basis points decline was recorded in the prior week. Market activity fell, with weekly turnover declining to 26 million ZiG from 116 million ZiG. On the VFX, the All-Share Index gained by 9%, riding on last week's 7% surge. Turnover skyrocketed by a whooping 922% to 5.2 million from 506,000, and it was largely buoyed by a trades that took place in Innscor of approximately over 4 million over the week. Meanwhile, the interbank rate remained fairly flat over the week. Delta topped the turnover chart at 13 million ZiG, followed by Econet at 6 million ZiG, reversing last week's trend when it was Econet which led at 62 million ZiG against Delta's 51 million ZiG. We can see that in terms of market activity, it fell off over the week. On the VFX, trading was dominated by Innscor and Padenga, with transactions amounting to 4.3 million and 500,000 respectively. In the previous week, trading was also dominated by Innscor and Padenga, with transactions amounting to 240,000 and 158,000 respectively. So we can see that the only difference between the week that we are reviewing and the prior week performance is in the parcel sizes. On the ZSE, foreign sales surged to 428,000 ZiG, right, to 698,000 ZiG, while foreign purchases eased to 1 million ZiG from 11 million ZiG. Meanwhile, on the VFX, foreign participation picked up. 3,000 purchases were recorded over the week, coming from no purchases at all in that prior week. Foreign sales surged to 3.9 million from a paltry 1K, which was recorded in the prior week. So looking at weekly turnovers of 26 million ZiG, as well as 5.2 million on the VFX, we can see that foreign participation on the VFX actually picked up, although it was net foreign sales, as perhaps some investors are trying to secure their capital gains, as we have seen major bull runs taking place on the VFX for the prior 2 weeks. On the ZSE, only 12 counters closed in the green against 14 laggards. Tanganda emerged as the week's top performer, and interestingly, last week Tanganda was the major loser, and a week before that it was a major gainer. Isn't that interesting, especially for those investors with speculative tendencies? Anyways, the chart clearly shows other gainers for the week right there, including Econet. Builder led the laggards list. On the VFX, it posted 8 gainers against no loser. Padenga led the movers, gaining by 30% in capital gains, and it was trailed by Edgar's, Simbisa, FCB, Axia, and Innscor. A clear bull run right there. On the ZSE, the top 10 counters by market cap, other counters remained fixated on their positions except for NMB, which replaced FMP on the 9th position, and FMP now assumes the 10th spot. On the VFX, Padenga replaced Innscor on the top spot. But as you have seen on the charts, that both Padenga and Innscor, they actually recorded double-digit gains in capital gains over the week. It is only that the growth in Padenga's capital gains outweighed Innscor's growth. Right, now here's our outlook. We're in the earnings season, right? And Padenga released its half-year financials for 2025 results. Axia and Innscor as well also released their half-year financial results, which we are going to unpack today. So for now, I would say all eyes on the VFX, as activity is likely to remain elevated in these counters. Meanwhile, on the ZSE, Delta and Econet, they are likely to remain major drivers of activity, but we do not foresee major bull run, during the course of the week, unless some notable changes take place, like on the macros, maybe, for instance, issues to do with the Zimra tax dispute, perhaps once there is a ruling or something of that sort. But thank you for tuning in. This marks the end of our first segment. Let's catch you on the other side. Welcome to our second segment, where we are unpacking the full year financials for Innscor Africa Limited, which released its full year financials for the year ending 30 June 2025. Looking at a player like Innscor, it portrayed a point of two tales. That's the first quarter ending 30 September 2024, which was marked by quite some challenging headwinds, where we saw the local currency being devalued. But for the other 9 months ending 30 June 2025, it was fairly stable for the group, and it posted 19% surge in revenue in their top line, despite being operating in such a challenging macroeconomic environment. And we're also going to unpack Axia, which we saw a marginal 1% increase in its top line, but actually a huge upside gain on its bottom line, 40% on the profit after tax and 51% on the headline earnings per share. So I'm joined by competent analysts today to unpack some of these interesting counters that are listed on the VFX. I'm joined by my fellow brother and my colleague, Alec. Alec, welcome on set, and thank you for joining me for this discussion.
Thank you for having me. Thank you.
All right, it's my pleasure. Now, let's dive straight into it, and we start looking at Innscor. So Innscor reported a 19% surge in its top line. That's breaking the $1 billion mark, right, which it had recorded, I think, close to a decade ago. That's around 2014, before it actually unbundled. That's Axia and Simbisa for these counters to operate on a standalone basis, right? But the report actually specified that the first quarter was a bit challenging, and that's when we saw that's the quarter ending September, where ZiG was devalued, right? And now the ensuing 9 months, there was some bit of stability. And the first question that I want to ask, just to get your views and your sentiments, how sustainable do you think this newfound stability is, and what key indicators are you as an analyst looking right towards this that could affect Innscor's ability to maintain its growth
trajectory?
Yes.
Okay, thank you. I think to start off, there are not many indexes we need to track in Zim,
okay,
especially when it comes to macroeconomic activity, except the volatility of our currency,
okay,
in terms of exchange rates. So I think we might need to watch out for that stability. Maybe have a look on policies which might be released that have a tendency of affecting our currency and its exchange rates. So I think those are two major metrics I would want to track in terms of the stability we are enjoying right now.
Okay.
But I think it has been quite a good run in terms of the economy. The ZiG has been fairly stable. I think that's what even drives the results we are talking about.
In terms of volumes? In
terms of volumes, yes.
But also it's encouraging to take note that a greater portion of their revenues in USD.
Yes. So I think it's also being driven by the stability. When people have that certainty to say the ZiG would be stable, maybe they would spend a little bit more or with ease than to have that mindset of thinking maybe things will go south. I'll need to save these small US dollars for a rainy day. Okay. So I think it's many thanks to the stability we've been enjoying right now.
Okay, thank you. That's an interesting take. Now let's move on to the regulatory and the tax challenges. We saw that the sugar tax on the beverage is SPU.
Yes,
They paid yes, they paid about 10 million in sugar tax. And perhaps if we are to juxtapose and look at other players in the beverage segment, maybe Delta paid about 21 million also in sugar tax. What I'm just trying to put into perspective is the aspect that it's a headwind for the group, right?
Yes.
Because it's something that they might not have anticipated at the beginning of the year.
Yeah.
Then we also look at the Zimra tax challenges. Again, looking at all of the counters, like I was talking, Delta is actually its pending issue, the 74 million tax disputes, the historical tax disputes for the period 2019 to 2021. And Innscor applies the same as well. They have about 13.4 million, right, in its historical tax disputes. So how do you factor these regulatory challenges as well as the uncertain tax liabilities in your valuation or risk assessment for the group?
So in terms of the sugar tax, I think they have to innovate around it.
Okay.
Because I don't see it going anywhere anytime soon. Maybe it might be adjusted downwards, but that would be wishful thinking if we're being honest.
Yeah, sure.
But I don't see that one going anywhere anytime soon. So I think they will have to innovate around it. Maybe they are able to come up with other product lines which are sugar-free or which uses less sugar to counter that effect. And then in terms of the tax issues with Zimra, I think it's a tricky one, but I've realized that they have treated it as a prepayment.
Which is balance it.
I wouldn't do that, because with Zimra, we have seen them won more battles than they lose. So yeah, we can proceed. Maybe we're not privy to the details of the arguments they're appealing, but if I'm being conservative, I think I wouldn't treat it as an outright prepayment, just to be on the safe side, and to be cautious, because Zimra is a way of
going about with these things.
Yes.
Okay, interesting. Now let's look at the segments. Of course, Innscor has got three main SBUs. That's the milk segment, the protein segment, and the beverage and other light manufacturing segment. And we saw, I mean, of course, we do know that the milk segment is the one that contributes more towards the top line. And in terms of the performance, I mean, the volumes were actually up. And I think National Foods, which is under the milk segment, it saw an 18% growth in terms of the overall volumes. But if you are to look at other segments, right, looking at the protein segment and even the beverage segment that we're looking at, I mean, in the previous question, where they face some headwinds, we saw that there were some quite significant, I mean, issues. Of course, although there were some other sub-segments that performed well, even, for example, Pro-Dairy and the beverage, I mean, their volumes were up. But in your view, what explained the divergence between these segments, and what are your prospects towards the turnaround of these underperforming sub-segments under the protein and the beverage segments?
So I think for the most part it's to do with the tax. Because under the protein segment there is that meat tax that was also introduced almost the same time with the sugar tax. So I think that also contributed to the small movement. But if my memory serves me well, I think it was since reversed the protein tax on meat. So I think they need to watch out for that one in terms of policy making by our government, so that they will find ways to innovate around the challenges, as well as the beverages. As we said in the previous, I don't see that going away anytime soon. It's there to stay. If anything, they have to absorb it. And if they're going to move away from it, they might lose business. So I suggest maybe coming up with other innovative ways which consume less sugar and proceed as a business. But in terms of them going away, I don't foresee it going anytime soon.
And capital expenditure has been the main issue to do with the group. we've seen them deploying about 74 million in capex for the year ending 30 June 2025. And in this current year, they are likely to deploy the same amount, the same range towards capex as well. So I would just like to hear your sentiments that where do you foresee most significant returns coming from in terms of the group's business model, and how does this aggressive investment strategy position the group towards against competitors, even whether be it in the short to medium term?
So Innscor is a unique group, if we are to be honest. Its competitors, I don't think they will stand a chance.
Okay.
Yeah,
in its core
business line, yeah, because it being FMCG, I think it's performing quite well in terms of its business model and execution. I think they have a solid strategy, as we've mentioned earlier on, to say about most of their revenues are now in USDs. So I think they are enjoying quite
an economic mode,
yes, in terms of the benefits that accrue with stability, which we talked about earlier. So I think, yeah, they are in the right course if the macro fundamentals don't affect them significantly, which I don't foresee anytime soon. I'm sure that's why they are deploying so much capex in terms of supporting their growth. I think it's a good trajectory there.
Yeah, and they are robust here in terms of their capex and just how they confront the market, because I've seen they've built the first plant in terms of the pasta, right, under the bakery division, and they've built state-of-the-art machinery, whether be it in Bulawayo and in Harare, for that bakery division as well. But okay, now as we wind up on Innscor, we've seen the group generating, I think, around 104 million in operating cash flow, right? And this was a 20% increase compared to the prior year. And this also supported the capex that we're talking about, right? But there was also an increase in terms of the dividend per share, which was also attributed to the shareholders. I think about an 11% increase in dividend per share. How do you view the company's balance between capex and retaining value to the shareholders?
So I think we can both agree that the capex is some serious spending there. So I think they are able to balance retaining some monies to the investors, as well as spending some on supporting their future growth. I think maybe they have a view that they are not yet there in terms of growth, so they need to support that growth in terms of capex. That's why we're seeing significant expenditure. But they are also cognizant to the fact that the investors would also want some return. Hence, they're trying to create I would want to say a healthy mix of capex and retaining some dividends to the investors, which is, I think, for the most
commendable, because those are the two important levers for any business, right? Growth, and is always retaining value towards your shareholders.
Catching up, like as their peer, I think it's a good mix they're trying to execute there. Because some would say, no, we have the chance to expand, let's just expand, and then
you do away with retaining value to the shareholders.
So I think it's also good to keep the investors happy. And I think it also help them bring more funds if need be.
Exactly. It becomes lucrative in the market, even to other prospective investors. Thank you so much. Now let's move on to Axia, a retail and distribution major player, especially here in Zimbabwe. Of course, for the benefit of our audience, when you look at Axia, it has got also three main SBUs. That's TV Sales and Home, Transav, and DGA, Distribution Group Africa, which is operational in Zimbabwe, in Zambia, and in Malawi. All right. We saw a marginal increase in revenue, that's 1%. But looking at the bottom line, we saw the profit after tax surging by 40%, and we also saw actually a remarkable increase in the earnings, headline earnings per share. So I would like to hear, the bottom line surged by 32%. I was now intermixing with Innscor. So I would like to hear your view. How sustainable was this bottom line surge, taking into account that the revenue only surged by 1%? Was it a once-off event in terms of maybe cost rationalization or cost optimization strategies, or it's something that you foresee as sustainable as you looked in the financials in how they optimize costs?
Yes. So I think in terms of the surge of 40%, looking at the figure alone, and we can't say Axia is in its infancy in terms of the life cycle.
Okay.
So taking into account those facts, I think that's not a sustainable growth rate. It will dampen, but I think to their credit, I think it's because they are trying to restructure in terms of pricing. Maybe they're being innovative around their products, and also maybe, as you mentioned, the cost rationalization program, which is, I think, it's paying dividend. Of course, we are yet to see how it will turn out going into the future, but I think if we start, it's showing good results.
All right. Yeah. No, that's interesting. Now let's look at just the operational of the environment. When ZiG was devalued last year, Axia lost about 2.3 million just in financial losses. And we didn't talk about Innscor, but I'm sure Innscor lost about 1.8 million also when ZiG was devalued. And of course, I attended an analyst briefing when Axia management was presenting their financials. And I'm aware that about maybe 90% of their sales, they are now denominated in USD, and 10% is denominated in local currency. And the management has got its own, projections of how they foresee themselves navigating just that environment. But what's your assessment in the group's ability to mitigate currency exposure as well as competitive pressures going forward?
So in terms of currency exposure, since most of their sales are now in USD, they are sort of insulated from market volatilities in terms of foreign exchange. Not forgetting their cross-border operations in Zambia
and Malawi.
So I think in terms of their operations, I'm sure significant revenues they generate from local in Zim, which are now in USD. So they are sort of insulated, but they should not relax. They should be watchful of the monetary policy coming up, any changes in the environment, so that they come up with products that sort of insulate them from changes in especially our ZiG / USD exchange rate
conundrum.
That's the major factor which they have to look out for in terms of coming up with products or their pricing models. They should always think about that so that they are not caught
off guard like they did in the previous year. Okay, let's zero in on the SBUs. We saw that TV sales and home revenue, the top line increased by 3%, and then Transav, it surged by 18%. This is the retail front. But if you are looking at the distribution business, that's DGA, revenue actually declined by 11%, though on a like-to-like basis, it surged by 44%. How do you view the growth prospects of the retail business vis-a-vis the distributorship business? In your view, is the new sole distributorship in DGA Zimbabwe enough to counter the structural challenges that the business is facing in the distribution sector?
So I think in terms of distribution, I want to believe it's a model they're yet to perfect.
All right.
It's not yet on point. I think they still need to work around in terms of executing the strategy.
Okay.
It's not yet there. like as it is coming out with the other two in terms of TV sales and
Transave.
And Transave. Of course, those two are also benefiting from the stability which we talked about in terms of the environment. People can spend more if they think
in prime locations where they are located.
They are located. So I think it's sort of different from the distribution business. But if they perfect the model, it should complement the other two in terms of revenue contributions.
Okay, interesting. Now let's look at capital allocation and shareholder returns. We saw the group declared 0.16 cents per share, in dividend, while there was only 1% decline in its cash from operations. But we also saw that there was a decline in borrowings from about 4.5 million, right? Which also signal, a bit of some strong financial position for the group. What's your analysis of the group's capital allocation strategy, right? How are they balancing value to their shareholders via dividends vis-a-vis funding for future growth? We also saw the group talking about coming up with new stores for this current financial year. As always, there was also a 5.80 million, which was actually approved by shareholders for capex. So just the same question that we asked for Innscor, how do you foresee how they're balancing capex and returning value to the shareholders?
So on that one, I would think they're trying to send a signal, maybe to the investors, that we also have you in mind, despite our challenges, despite our predicaments in terms of macro environment, we also have you in mind. So declaring a dividend sort of signals that things are starting to pick up. I'm not sure if they're going to increase or decrease going forward, because maybe they still have some capex to attend to in terms of balancing their SBUs. As we mentioned, the SD is not yet at par, according to my view. So I think they might need to maybe ease down on the dividends, but the signal is good enough to the investors. But I think they should maybe focus more on developing the not so much performing SBU going forward.
All right, interesting. I think this is now our last question as we do our roundup. Now, the group's forward-looking statement, it talks of growth strategy, like we have also said about them expanding their footprint, enhancing some of their product rangings and offerings, and pursuing competitive pricing, right? Considering that there is softer consumer spending mentioned in the report, how sustainable is this growth strategy? That's the question number one. Specifically, what impact do you expect from the relocation of the furniture manufacturing operations to the new Sunway City facility? And how crucial will this expansion of the digital channel be towards capturing market share?
Okay. I think going digital is a good move.
Okay.
As we might agree, you and me, that we now have different customers.
Sure.
We now have people who have access to technology, so they won't be comparing what they are buying from say TV sales to only products which are being sold in Zim. People are now importing goods from China. I think going forward they need to factor all those scenarios in terms of developing a solid strategy. But I think being a local player, if policy favors them, they stand to benefit in terms of their growth strategy. But I think they should be watchful of the customer, the type of customer they now have, because they are now exposed. It's now more easier to import stuff from China than to have something delivered from South Africa to Zim. So I think all those scenarios need to be taken into consideration in terms of their pricing as well as they go forward.
Wow. Yeah. Thank you, Alec, for those insightful and interesting points that you have raised right there. Well, that's all the time we have for today's recording. We have covered Innscor's full year financials for the year ending 30 June 2025, right? A player that has shown that performing quite well, a 19% surge in top line in this current environment that's accompanied with all its own headwinds, like the ones that we have alluded to that took place in the first quarter and in September 2024. We also looked at Axia, which saw a marginal increase in its top line, and we've unpacked some of its segments and looking at TV sales and home transfer and how DGA has been also facing its own headwinds. And the group, forward looking, we've also talked about how the group should, counter competition for both the formal and the informal sector, and just look at how they are able to navigate the other operating environments, be it in the Malawi and in the Zambian market. But before we, cap it off, allow me to thank my guest for today. Alec, thank you so much. It was more conversational and natural, just getting to unpack some of these counters for our audience. And I'm sure some of them, they've gleaned one or two from our discussion. Thank you so much for being with us.
Thanks for having me.
All right. Okay. And we want to thank you, our audience. Thank you for tuning in. Until next time, keep your eyes on the market. It's bye for now.